Welcome to the Academic Advancement Center Community Learning Forum on Tax Literacy. My name is Brandon, and I use he, him, and his pronouns, and I am really excited to offer this presentation to you today. It's my first opportunity to create a community learning forum, and I'm really excited for it. Just a reminder, be sure to fill out the Community Learning Forum, or CLF, evaluation form as soon as you finish watching this video. I greatly appreciate any feedback. Let's get started. Thanks for participating. As we move on, I hope that you'll remember the land acknowledgement and do your best to carry it with you throughout the rest of your day, week, and semester. The learning objectives for this community learning forum are pretty simple. First, we hope that you will learn about the history, very briefly, of taxes. Also, we hope that you will learn about the purpose of taxes. We hope that you will increase your understanding of common tax terminology, and we hope that you will enhance your knowledge of what affects whether you owe money or receive a refund during a tax season. And finally, we hope that you will know where to go for free tax filing and free tax advice. Let's get started. A brief history, purpose of taxes. Taxes have been around for a long time. The first record of organized taxation dates back to 3000 BC. Throughout history, taxes were a mainstay, often provoking and funding wars. In the United States of America, taxes have shifted from what once were mostly tariffs on imported goods to more complex and nuanced systems based on income taxes. In 1913, only the wealthiest populations in the United States of America were required to pay income tax. For more information, visit onlinebusiness.northeastern.edu. How are taxes used by the state? Well, it varies based on the state that you live in. This is a general breakdown of how state revenues are spent. For instance, K through 12 education might receive 25% of taxes, while Medicaid might receive 16%. Higher education and transportation might receive 13% and 5% respectively, while public assistance and corrections might receive 1% and 4% respectively. The other 35%, for example, could be used towards contributions to public employee pensions and health benefits, and contributions to aid local governments. All of these percentages here are estimates, as it does vary by state. How are taxes used by the federal government? Well, in 2019, the federal government spent approximately $3.5 trillion that was financed by federal revenues. Now, it's important to note that Social Security and Medicare are independent of FICA taxes or income taxes. But I thought it was important to include this information to know what money is being spent by the government and how. Social Security accounts for 23% of the federal government's expenditures, providing monthly retirement benefits, approximately $1,500, to around 45 million retirees, 6 million surviving children and spouses of deceased workers, and 10 million disabled workers and their eligible dependents. Medicare, Medicaid, CHIP, and marketplace subsidies account for another 25%. Approximately 3/5 of that to Medicare, healthcare for individuals 65 years of age and older. Your contributions to these programs, Medicare and Social Security, are based on your salary and wages and are not affected by deductions or credits. Medicaid and CHIP provide services for around 82 million low-income children, parents, elderly people, and people with disabilities. The U.S. government spends around 16% of taxes on defense and international security assistance, 8% on safety net programs like SSI, SNAP, and the Earned Income Tax Credit, and another 8% on interest of debt. Another 19% on various areas such as federal retiree and veteran benefits, transportation infrastructure, education, science and medical research, and non-security international. For more information, you can visit the Center on Budget and Policy Priorities, cbpp.org. This slide has some terminology that's important to understand as we move through the presentation. The first is tax liability. This is the amount of taxes that you are responsible for based on how much money you make per year. As you make money throughout the year, taxes are withheld from your check to pay toward that liability. In essence, the taxes withheld from your paycheck are being applied toward your expected tax liability. You can usually determine your expected tax liability by using a tax bracket that corresponds to your filing status. Tax brackets are determined by your adjusted gross income, how much you made minus the standard deduction associated with your filing status. Standard deduction is a predetermined reduction in taxable income for individuals. The amount varies based on your filing status. If you choose to itemize your deductions, you are not able to claim the standard deduction. The potential amounts are as follows. Single filers, $12,400. Married filing jointly, $24,800. And if you're filing as head of household, the standard deduction is $18,650. A tax credit is a dollar reduction in the amount of income tax that is owed. In general, these can be thought of as benefits, rewards, or incentives for spending money in ways that help the economy. A tax credit can reduce the amount of your tax bill when you're filing or increase the amount of your refund. Deductions, a reduction in the amount of income that is taxable. Standard versus itemized deductions. There are two ways to reduce your taxable income, standard and itemized deductions. Standard deductions are based on your income, age, and filing status, and are the same for everyone who files within the same category, such as single or married. People will often itemize when the itemized deductions equate to a larger reduction in taxable income, or when individuals are unable to claim the standard deduction. An example of what this looks like is that if you make $40,000 per year and decide to take the standard deduction of $12,400, your tax liability would be based on your salary minus the standard deduction, $40,000 minus $12,400, which is $27,600. This means your tax liability would be based on $27,600, not $40,000. For more information about how standard and itemized deductions work, please feel free to visit irs.gov. Tax brackets are an easy way to see how much and at what percentage your income is taxed. As you move down the tax bracket, you can see that the percentage at which your income is taxed increases. For instance, $0 to $9,875 of income is taxed at 10%. As you go above $9,875, the amount at which that income is taxed increases. For instance, in the second tax bracket, $9,876 to $40,125, your tax rate is $987.50 plus 12% of the amount over $9,875. It's important to note that your taxable income is determined by your salary minus either the standard or itemized deductions discussed previously. Here are a few tax credits that you should know about. One is the Lifetime Learner. This credit is a maximum of $2,000. It's non-refundable and it has an income limit of $68,000 per year. It has an unlimited tax year applicability and it's to be used towards tuition and fees. Non-refundable means that it only reduces your tax bill. It cannot increase your refund. Another tax credit is the American Opportunity Tax Credit. This is a maximum amount of $2,500. It's partially refundable. It can only be used for the first 4 years of college and is only available for 4 separate tax years. It can be used for tuition, fees, and expenses. As I mentioned, it's partially refundable, meaning a portion of that $2,500 can actually go towards increasing your refund. Another tax credit, the Earned Income Tax Credit, is not available to those who are married filing separately. It is refundable. It is based on how many children you claim in your home and your income limits. The range of credit goes from $2 to $6,557. On the IRS.gov website, there is an Earned Income Tax Credit assistant. That assistant estimates a person filing single who made $12,000 with no children in the year 2019 could expect a credit of approximately $271. Here's an example of tax credits and how they may possibly affect your situation. Imagine that it's the day before taxes are due. You log into TurboTax, or perhaps you use one of the free services we'll talk about a little later, and you fill out all the boxes and you press enter. Oh no, it says that you owe $2,025. Now, if you participated in or completed a qualifying purchase that counts as a tax credit, you could reduce the $2,025 owed. For instance, the American Opportunity Tax Credit is a credit for qualified educational expenses. You can get a maximum credit of $2,500 per eligible student. If the credit brings the amount you owe to zero, you can have up to 40% of any remaining amount of the credit, up to $1,000, refunded to you. In our example, this means that there would be a $2,500 reduction in your tax bill. This would be $2,025 minus $2,500. That's a negative $475 amount. Being that the AOTC, the American Opportunity Tax Credit, is a partially refundable credit, you would be eligible to receive 40% of the remaining balance, $475. 40% of $475 is $190. You would go from owing $2,025 to actually receiving a $190 refund. Forms. The W-2. Every employer who pays individuals, including non-cash payments of $600 or more for a year, must file a Form W-2 for each employee. This is usually sent to you in January. The W-4. It was recently redesigned to reduce the form's complexity and increase the transparency and accuracy of the withholding system. If you only fill out your information and sign, your withholding will be computed based on your filing status as standard deduction and tax rates. 1099 miscellaneous. You receive a 1099 miscellaneous for making at least $600 in rents, prizes, and other forms of income. Where to go for tax help. Here is a list of local places here in Fort Collins, Colorado, that have offered free tax advice and filing assistance for individuals. Given the current climate of our world and the COVID-19 pandemic, it's important that you contact these facilities to ensure that they are operating this year and in what capacity. The locations are the Fort Collins Senior Center, Old Town Library, Council Tree Library, Colorado State University Rockwell Hall, Front Range Community College, and an online service called the VITA program, which is IRS's Volunteer Income Tax Assistance. They offer free tax help to people who generally make $57,000 a year or less, persons with disabilities, and limited English-speaking taxpayers. How to prepare for tax season. The first step is to start gathering your tax records. It can be the W-2 or W-2G form, a 1099-R or a 1099 miscellaneous form from banks and other payers, other income documents and records of virtual currency transactions. You'll need to include your Notice 1444, your economic impact payment from the COVID-19 pandemic response, any unemployment income, refund interest, income from the gig economy, or virtual currencies. You'll want proof of identification, Social Security cards for you, spouse, and any dependents, bank account number and routing number for direct deposit, and a copy of last year's tax return, if available. You'll also want receipts for total paid for daycare and the daycare provider's tax identification number. Last part of the presentation is just a quick reminder. If you received a COVID CARES grant through CSU, you do not need to include that on your taxes. It will not be considered part of your taxable income. Thanks for watching. I really hope that you learned something today, and be sure to fill out your CLF evaluation form.